How's it going in Florida, man?
It's going good. We're just doing the best we can to get through these very uncertain times. So I'm just trying to do what I can to help people kind of navigate through this.
Yeah, you've been doing a great job, and we all appreciate it. So I work with people all over the country that syndicate real estate, and your message is resonating with a lot of people right now. It's tough times. It's nobody knows which direction to go. Well, let's talk about real estate syndication. There's a lot of junk out there right now, and I think what's going on is a lot of people don't understand what real estate syndication is, which is pooling capital from investors to do bigger deals, right? And that's kind of what I help people do. So in terms of real estate syndication and what you do specifically, just for people that don't understand, I mean, there's thousands of people all across the country that do exactly what you do. They syndicate real estate deals. They use social media. They use events to educate people, to educate investors that want to invest with them or teach them how to do their own deals. So it's a very common thing. And what you do is just phenomenal. And the way you've done it's really cool. So it'd be neat to kind of hear your progression in terms of your first deal, and then, how you went along and how you built and scaled this thing so quickly.
Yeah. So, yeah, thank you. I really don't, I know I am by definition a syndicator, but the way we do it is a little different. A lot of guys that you mentioned are educators and syndicators. Less than 0.5% of our revenue comes from education. If you look at other people that are doing this, they're probably 50-50 or more. And, our focus is on deals.
Yeah.
And secondly, I buy the deal in the past, at least up until this moment right now, our current fund, I buy the deal with my money before I offer it to the public.
Right. So you're just recapping it.
Yeah, we recapitalize it, but we're funding, and they're massive. These are big deals. These are as big a deals as you can buy before you get to billion-dollar real estate portfolios. These are $100 million, $140 million, $90 million deals. Probably average size transaction is above $80 million.
Yeah. So you're getting there.
Yeah. Oh, yeah. You'll get there. You'll get there. And look, it's easier to manage deals, especially in times like this. You want to be in the bigger deals.
Yeah.
Because the number of units that I've stated many times, the number of units is what gives you the ability to go through a cycle like we're in right now with uncertainty.
It's surprising how well the market's doing now. Retail, hospitality, office, different story. But multifamily across the board, especially the type of assets you buy, are extremely resilient in economic downturns. I went through 2008 and 9, and multifamily performed well, especially Class A, B plus, right? Core plus did extremely well in those times. But so when I was talking about education, what I mean is more of the thought leadership platform. So there's a lot of guys that have a show, have a podcast. They're using that for thought leadership to kind of educate people and, help them understand what they're doing so they can invest with them or whatever.
Yeah.
But the other thing too is a lot of these guys don't do their own deals. So there's the difference between you and what a lot of people do that I don't think people understand is it's Grant Cardone on the contract. It's Grant Cardone signing for the bank. It's not Grant and 5 other people. So a lot of these guys out there that are doing these deals, they've got 4, 5, 6, some of them have 10 partners that are all, trying to do one deal at 20, 50 million bucks.
Yeah.
So that's a big differentiator as well.
Yeah, because what happens, particularly in times like this, when you have 10 partners on a deal, it's like having 10 guys on a plane. 5 of them are fine. It's the other 5 that want to sell. And when you get 5 partners that are in a financial situation where they need money, or they're like, I want distributions this month, I don't want to use it for carpets and improvements. There isn't 10 guys on my deal. There's one decision maker on my deals. I buy all these deals based on whether or not I want my family's money in this deal, meaning my money. And so going back to your first question, which was how does it start? It started with a single family house. I learned very quickly that does not work. At least
and that was 30 years ago, right?
30 years ago, I bought a single family home, rented it to 2 girls. It was fine until they moved out. When they moved out, I'm like, I'll never do this again. How fast can I learn? And what I learned there was, and by the way, this might be good for some people. I was running 2 other businesses. I didn't want to manage real estate. I wanted to invest in real estate and collect passive income. And the moment they moved out, I was responsible for the property, mowing the lawn, pesticide treatments, filling the place back up. And there wasn't enough revenue involved for me to be interested in doing that because it was costing my other two jobs attention.
Right.
For $200 a month in cash flow. And now I was worried about the debt as well. So the upside wasn't there. The real estate wasn't the problem. It was the grade of real estate, dependency upon one tenant or a couple of tenants in this case. And so I sold that, actually did pretty good. I had $4,000 or $5,000 invested, came out with $5,000 plus. And then my next deal wouldn't be for 3 years because I went and spent 3 years studying real estate, the right way to do it. And my next deal would be, I think, 48 units that I bought 3 years later that I made, I don't know, $4 or $5 million in that one deal.
So how'd you get the down payment for that?
Yeah. So my other two companies, and I've been doing this for 30 years now, I have multiple companies that generate cash, and I take the surplus cash from those businesses. I reinvest what I can for advertising, marketing, branding, expenses, expansion. And then if there's anything left over on top of that, I take that money. I do not stay around with a lot of cash. I take that money and I invested it in real estate. My first real acquisition took $350,000.
Yeah.
On a $1.9 million deal. But that $350,000 4 years, 4.5 years later was worth, I think, $3.6 million cash.
Yeah.
So plus I had the cash flow from the property. Back then we were buying stuff for 10 and 12% cash flow returns. I mean, the mistake I made right then was I didn't know I should have refinanced that property and I should still own it today.
Yeah. So you sold that one and then you took that. What was your next deal after that?
Well, I did that deal 30 days. I bought that deal. 3 years after the single family, I bought the first deal. 30 days after that, I bought a second deal. And 60 days later, I bought a 90 unit deal. So I went like 48 units, 38 units, and 92 units. And then I stopped, and I should have kept pressing, man. I just, because I had the cash. I was accumulating cash from other business. I would take the cash and I would throw it in these deals. Now, this is kind of a weird thing that a lot of people never ask about. It's like that money, if I'd have reinvested that money in my business, I could have probably earned 100% on my money. But the difference is the real estate allowed me to invest in a third business that provided monthly cash flow. Like those deals would still be cash flowing, 30 years? Like I would have paid for those deals 4 or 5 times already.
Yeah, all those buildings are still there throwing off cash right now today.
They're occupied right now at 95%. I know who owns those. I've been following those deals for 30 years. So they're still in good locations, probably better locations today than they were then. They survived through 2008. They will survive 2020. And, that being said, I needed the money to do bigger deals. So I sold those deals to buy bigger deals.
Yeah.
My next batch of deals would be about 3 years later. I bought 2,200 units in Tucson, Arizona, stayed there right before the crash, got out and moved back into I took the 2,200 units and collapsed it into 3 properties in San Diego, weathered the 2008 storm, sold them in 2011. And then since 2011, 2012, I've just been really hammering down. Now we're at 7,700 units, trying to get to 16,000. I'll probably double my portfolio now because of the COVID-19.
Yeah. So somebody asked me to ask you that. So thank you for sharing that journey. Because a lot of people look at you and they're like, man, there's just no way I'm ever going to get there. Right. I've got this 100 unit portfolio, or I've got this 1,000 unit portfolio, and you're sitting at 7,000. So, it's that simple, right? You do the deal, you sell it, you take your cash flow, you do a bigger deal, and you just keep going.
They're easier to do. Like, this is the mistake I made in the beginning. I should have done that first batch of deals and shifted.
Mm-hmm.
And I don't know how to stress this to people enough. I know it's hard to think about. I used to do 300 person events in our conferences. Doing an event with 3,000 people is easier than 300. And buying 500 units at one time is easier than buying 50. You get better debt, better leverage, fewer people looking at the deals. The bigger the deal, the fewer people you have to compete with. And now the only issue now is the cash down.
Yeah.
So if you can get over the cash down and start asking yourself good questions like, what could I do to come up with the cash down? See, people are buying real estate based on how much money they can have or how much money they can raise. And rather than doing that, that takes your attention off the best stuff. The question should be, how can I buy the best stuff? And then do what you need to do to buy the best stuff. So I figured out how to quit taking shortcuts years ago and said, hey, how could I buy the best assets? Why is that important? Because I want to buy something I know I can sell. And if I'm buying something that Blackstone is bidding on today, Blackstone becomes a buyer for me when I'm ready to exit.
Right.
If I'm buying something that a dentist is competing with me on, then I'm probably going to have to sell to a dentist. And that's not who you'd want to sell to today. Blackstone has enough money to do a deal right now. 1 month into this COVID thing, they have enough money to buy a deal right now for cash. The dentist isn't going to buy a deal right now. A dentist will not get a loan. Nobody's going to get a loan right now. Blackstone won't need one. So the point, what I'm telling people is what I've learned. I've learned so much over the years. Like, I should have bought more. I should have bought bigger units. I should have bought nicer units. I should have bought lower cap rates, not higher cap rates. Like, I'm just sharing the mistakes.
Yeah.
I should have not sold anything, really, and I should have raised money sooner. That everybody's like, oh, Grant Cardone's going to go bankrupt and he's going to lose everything and he's over leveraged. We're 60%. Our lowest leverage is like 55% in some deals.
Yeah.
60% across maybe a third of them, and no more than 75% on anything.
Yeah, that's what I've seen. I've looked at your deals. I've seen you've got low leverage, prudent, and it's the number one thing you should do because you don't know what's going to happen next month. So your job, first and foremost,
about what I did, because you've been following.
Yeah, exactly. I've been following you, and I've seen the criticism out there, and what people don't understand. A lot of people just don't understand the business. And what they don't understand is what you just said. Your job, first and foremost, is to protect the capital that your investors and you invest in those deals. Preservation of capital. So you got to be defensive, right? So you got to make sure that you're shoring up your reserves just in case something happens. I've seen your deals. I know that you can probably break even at 30% vacancy, and you're still breaking even. Doesn't mean you can pay distributions, but you got reserves. The property will carry itself. But if for some reason, all of a sudden you hit a 50% vacancy, well, you're going to need those reserves. So the last thing you want to do is not be able to carry that property. So pretty much everybody I know across the country with larger, assets are doing the same thing.
So we would have to lose 38% of our renters to break even. And then what people don't know about my personal financial situation is I could take the entire $1.1 billion worth of debt I have and fund it for the next probably 2.5 years.
Right. And that's the other side of the equation that people don't understand, that don't really understand this business. Number one, you're protecting the asset. It's a defensive play. It's prudent. Number two, you've got to have a balance sheet personally to guarantee these loans. Now, a lot of people know and have heard the term non-recourse, but they don't understand that still requires a key principal, a loan sponsor, a loan guarantor. So you got to put your balance sheet up against these loans.
Yeah, of course, and what you don't want to do with the syndicator is the longer the term with the syndicator, the better off you're going to be. Wall Street has made the short-term 3 to 5 year thing, like they're doing a favor to the public.
Mm-hmm.
They only do that so they can sell the deal and get their fees. They want their fees. I don't want my fees. I want to protect the asset because I know in 2030, these assets will be worth a great deal more money, particularly at the rate that we're printing money. Remember, in inflation, the asset value goes up. If I have permanent debt, the debt does not inflate. Okay, I'm buying yesterday's dollars, waiting on inflated dollars to pull up the value of that asset and the rents. Because in inflation, a $1,200 rent If we go into massive inflation, that rent's going to go up. Now, I'm not wishing that on anything. That's not how you make money in real estate. But there is some natural inflation built in to a good real estate model. When you stabilize that debt, like on all our deals, we have 10 years of debt. Fannie Mae and Freddie Mac, they're as much a partner in my real estate as an investor is.
Yeah. So, and that's the other side about the big deals, right? Is that that's what they're in business to do. They got to get that money out on the street. They have a mandate, and they want to do those big deals because it's easier for them. And
they like the long term too. Like they love. I'm a preferred borrower with Fannie and Freddie. They love the idea that I don't, because other guys do have 3 to 5 year funds, and I'm not bashing on them. I'm just saying when you can go to your lender and say I don't have to sell for 10 years, they like that. I had 3 deals, 140, 90, and I don't know, about $300 million worth of deals sitting on the books.
Mm-hmm.
Real estate, the kind of real estate you're talking about, big apartment complexes, affordable rents, good locations. This storm that we're in right now is going to make these assets more desirable, not less.
Interesting times. So on that note, moving forward, so you want to double your portfolio over the next year. So what's the plan moving forward to strategically do that with foreseeably the demand rising?
Number one, take care of the properties you have. If you don't take care of the properties you have, you're not going to go get other stuff. Shore up your cash reserves. 3, be in touch with your lenders. 4, you need to be in the market looking at deals. So if you're not looking at deals today, because there's nothing going to happen. I see these guys, they're like, this is what I was waiting for. I'm like, bro, you're not going to buy anything. If you didn't buy anything in the last 2 quarters, you're not going to buy anything today because nobody's going to talk to you. You have no history. Management is going to become more important than money. Like I know that I'm going to get deals offered to me and money will not be the issue. They're not going to be like, we need a bunch of money for this deal. They're going to come to me because I'm in the market talking to them right now. And this has happened. You've seen it happen before. Like stuff is going to go back to the banks, and the banks don't put it on the market. They make phone calls.
Right.
Hey, Grant, can you take this 10,000 units? I could do all 7,000 units in one purchase in this next time.
And let's dig into that. So when you say they're going to call you and say, Grant, take these units, I mean, literally, folks, that's what's going to happen. They're going to call Grant and say, hey, will you assume this portfolio and you won't have to put a nickel into it because they know you're an operator. They know you're strong. They're going to give them to you.
Yeah. But I mean, with them giving it to me becomes a lot of responsibility, a lot of risk, a lot of work, a lot of due diligence. It's not always a gift.
Right.
Sometimes when people want to give you something, it's not always. But first of all, I'm going to get the phone call. You have to be in the game. Now, I'm not talking about single family. I'm not talking about a duplex or a fourplex. You can find that in your neighborhood, probably find somebody in trouble, but you're still 6 to 9 months away for any of that to happen either. All this federal stimulus money is going to stretch this cycle out. So any of the bottom feeders, you won't be able to actually come play. These deals are going to happen at institutional levels this cycle. And the play is going to come, Greg, from probably a fund that had 2020 as their target to get out of Orlando.
Right.
Or they wanted to exit Atlanta. They had been there 6 years. This is their year. And trust me, they're going to sell this year.
Right.
And if they don't get their money, I'm talking about $1 trillion companies, not $1 billion companies.
Yeah. The guys that have 50 to 100,000 units.
Yeah. 140,000. I was on the phone call with a guy the other day, 180,000 units.
Yeah. They're going to peel 10,000 here, 20,000 there. And they do that all the time because, that's how they make their money.
I got 7,000 units I have to get rid of this year. Okay. Right. They're in 3 states. Are you interested? He's going to take his losses on them or break even, or he didn't quite get his coverage. He's going to bury it in the rest of his portfolio. He's got 180,000.
Yeah. And by the way, there's 3 guys that he's calling right now, and you're probably one of the 3.
Yeah. See, people should be listening to you rather than Flipper Fred, because you understand the game at that level.
Yeah.
And, I see all these YouTube videos. Some guy says, Ted the Flipper is saying that you're gonna go you're upside down. I'm like, okay, all right. Well, you'd have to know what the property's worth, what I paid for it, how much debt I have on it, how much cash burn that I have, what my occupancy is on it, what my debt is on it, when my debt matures, and what is the cost of my debt. Like how can you know that without knowing those 7 things?
Right. And I can look at that in about 30 seconds at one of your deals and know you can sustain a 30% hit and you're going to be fine just looking at the 1-page, cut sheet on your deal.
Yeah.
Yeah.
But,
so it's interesting. The other thing.
There's a lot of YouTubers out there, just they're trying to get YouTube views rather than buy real estate. You and I are trying to buy real estate because we know long-term, it'll probably take care of our families better than YouTube views.
But, people just don't understand. And that's why I wanted to do this today, because they just don't understand. Like I heard one guy make a comment that you take 65 or 35% of somebody's profits. And it's like, come on, this is a cash flow split, right? So if the property makes a profit above, all of the expenses, it's a 65-35 split of that cash flow. That's after they get their 6% preferred return.
Yeah.
And that's a great split. I mean, the deals that I've done in the past, people be lucky to get 50%. I never
by the way, after the 6% really results in, if you total the 6, so we pay, for your viewer, we pay a 6% preferred on our existing portfolio. So if you put in $1 million, you would be paid $5,000 a month, $60,000 a year. If we own the property for 10 years, you would have been paid $600,000 of your $1 million back, as long as I made the cash flow.
Right.
Now, before I get anything, I got to make sure you got your $600,000 over those 10 years.
Right.
Above that number, when I go to split the money out, I got to pay your $1 million back. As you know, I'm talking to the viewer. I've already paid them $600,000. I give them their $1 million back. And let's say there's another $1 million left over because of the way the profit split. Out of that other $1 million, I would get $350,000. You would get $650,000. That means your $1 million would have turned into $1 million you got back, plus the $600,000 in cash flow, plus the $650,000. So you'd be at $2.250,000 on $1 million investment, and didn't have any management headaches, didn't sign on the loan, didn't find the deal, didn't call the banks, talk to the banks, manage the tenants, blah, blah, blah. So I would make $350,000 off that transaction only because I held the asset, didn't lose anything, and managed it to a profit. Yeah, also, let me just say for everybody to understand this, you're like, oh man, you made a lot. I could have made the entire amount if I'd have just not given that person access to this transaction. And I bought the deal without their money. So clearly I had the cash to buy the deal because they came in after the deal was bought, funded, and managed. People have been buying deals for me where there's already cash flow. Going forward over the next 2 years, I'm probably going to change that. No preferred, and you'll have to come in blind, meaning you will not know the asset I'm buying beforehand. It'll be an opportunity fund.
Yeah, straight pref. And if talking about Blackstone, so that's what they do, right? So they have investors, just like you have investors that put, 10, 100, 10 million in their fund. All they get is a preferred return. Some of them are institutional funds that are investing with those guys. And that's why they're buyers, by the way, because they've got these life insurance funds and endowments, pension funds. They're like, look, we're tired of having to hunt for another deal. Just keep our money in, so, that's why Blackstone is so hungry right now. And, they'll buy a 3 cap because they want to keep the money rolling. And all those investors, that's all they get is a preferred return. They're not getting equity in the deal at all or depreciation.
Yeah. I wish people understood what you just said, because I don't think they do. They don't understand how Blackstone could buy a 3 cap, why they would buy a 3 cap.
Yeah, it's just yield,
right?
My
whole plan, Greg, just so you know, is to take our portfolio, continue to expand it, and make one sale.
So you're a value add portfolio play. So what people do normally in this business, they buy one asset, they increase the income, which increases the value, and they sell it. So what Grant's doing is you're doing a portfolio value add. You're accumulating trophy assets that the big dogs are going to want. So when you get that 10, that 20, 30, 50,000 unit level, now you've got a $10 billion fund that you can sell. It's a value add portfolio.
And I'm solving a problem.
Right.
How do you make money? You solve problems. So
the big guys need something to buy, and they can't buy you right now. You need to 10x what you're doing so they can buy you.
Yeah, they're not interested in a little $1 billion deal. They're interested in a $10 billion deal because how do they grow? They're a $1 trillion company. They don't want to grow $1 billion at a time. They want to grow 30 billion, 100 billion at a time.
Right.
And I think they're a $650 billion real estate fund right now. So, you know, somebody over there has got to be, Steve Schwartz got to be like, I want that to be a $1 trillion fund.
Yeah.
So how does he do that? He's going to have to make 35 $10 billion transactions, or he'd have to make 350 $1 billion transactions. And it's probably going to be easier for him to buy 35 guys like me than to buy 350 $billion guys like me. Yeah. And what he's going to look for is assets. Now, the reason he's got to buy those is because he's got Allstate, State Farm, Prudential, MetLife investing billions, not $10,000, billions and billions. And they're looking for a 2.5%, 3% return, 3.5%. But mostly what the MetLifes are looking for is not to lose money. Right. And then cash flow long term.
Yeah. If they can get a point on, $100 billion, they're doing okay.
Yeah. They're crushing it. And that's what they're trying to protect. And they're trying to protect their fees. Yeah. Because they get a fee for managing $1 trillion.
Right. Different game, different level, different value add.
Different strategy. Game, but everybody that's watching you could benefit because for maybe you're not going to be a $10 billion fund, but look, a guy like me is looking for 3 or 4 assets in Atlanta that I can buy from John that's watching this. See, you would feed my beast. I would feed their beast. So like we're all connected in this deal. Like I don't want people being foreclosed on. I don't want people going bankrupt. Yeah, it would benefit me. That's not what I want because for every benefit, there's a disadvantage, which means if I got both of my neighbors go under, it pulls down the value of my properties and my rent. I don't want, even though I'm not in shopping centers, I don't want the shopping center to go dark. Like people are wishing for the wrong things right now. You guys don't wish for people to fail. Wish for people to succeed because it pulls the value of your stuff up. When the whole neighborhood goes black, meaning out of business, the lights aren't on, the shopping center, the barber shop, this doesn't help anybody. And so I would rather everybody stay in business. Stop all this speculation in the building of apartments. It's going to be very destructive to single family homes. What do you think about that?
Yeah, that'll be interesting. Most housing markets are still hanging in there. So that's an interesting contemplation in terms of where that's going to go. Right now, they're still pretty strong. Inventory levels are down. The builders can't keep up with demand. So I think we're okay there for a while. And, not everybody rents forever. So there's a lot of people, it goes both ways. You get seniors that are retiring into apartments. You have younger people that are coming out to have a family with the yard and the fence, right? So it's kind of a interesting cycle. I think there's a delicate balance there. And I think what happens in a lot of areas that a lot of people got to be careful. If you've got new construction of apartments, that's fine, but just watch the attrition because, the class Bs are going to become Cs, the Cs will become Ds, and the new stuff takes over. So it's kind of a, an attrition kind of thing. Same thing in the retail and office. We're going to see a lot of those get repurposed into different types of, maybe they get turned into apartments, maybe they get turned into assisted living, which that trend started happening anyways. And I'm a developer by trade, by the way. That's the business industry I grew up in. So I've been a merchant developer my whole career.
You got more guts than I do.
Yeah, I like it, man. I just like a challenge and I like the risk and all that. But look, I know you only had a little bit of time. I don't want to hold you up here. But I appreciate you, taking time out and doing this today. Is there, what I see from Grant Cardone, there's a lot of stuff out there. I see a guy who pulled himself out of drug addiction, who educated himself, who got a job, took a job you didn't like, became the best at it, went out, taught other people how to do it, used that cash flow, built a business around it to invest in other assets. Here you are today. And if Grant Cardone can do it, anybody can do it, right?
I can't cut my hair.
Yeah.
But I do know 30 years that I've been studying real estate, I have figured out something that never lets me and my family down, has never let their investors down. I got sisters, brothers, nephews, and nieces invested in our real estate. I'm so confident that this asset class has delivered to me for 30 years. Even when my other businesses failed in 2008, I had two businesses that were failing. The apartments kept paying me. And it was painful for real estate. That was the worst real estate crash we've ever had in this country. My apartments came out before my two other businesses recovered. The apartments were cash flowing and we were raising rents. Literally 14 months after the collapse in 2008, we were raising rents already. So it was like the mistake I made again. I didn't own enough real estate then, because it is a necessary, vital. Where's people staying today? People are staying in their homes and in their apartments. So this is going to be a great place. If you're willing to study, do the work, walk properties, learn about properties. If you're willing to do that, I promise you, you and your family will be well served over the next decade in apartments.
And it's been proven over and over and over.
And you don't have to be a smart guy to do this.
Well, that's awesome. Well, Grant, I appreciate you taking time out today. I know you're busy and you're doing a lot of good stuff out there. So awesome.
Thanks, Greg. Thanks for what you're doing.
Yeah, man. Take care.
Hey, we'll get you a copy of this, all right?
Yeah, I appreciate that. That was awesome.
Yeah, that's great, man. I tell you what, nobody's doing the show you're doing. Like, you're doing a show. It's not institutional because they're never going to do anything. This is a good show.
Yeah, I'm just trying to help. I'm just trying to help guys and, put the truth out there. I don't advertise. I'm not looking for clicks. I just want people to see, look, this is how business works, man. You're doing what you're supposed to do.
Yeah. But I mean, if this is people love this show. So I'm going to try to think of some other names of guys you can interview.
Yeah.
Because you're going to really benefit the audience.
Yeah, that'd be awesome. I appreciate it.
I'll send you a copy of this. All right.
All right. Thanks, Grant. Take care.